Folks, we're back with John Harms. Market update. It's been a crazy few months, as we all know. If you just watch the news at all, things are volatile. Right before we hopped on here, John, you were talking about how you looked at AI or ChatGPT to say, what are people most concerned about? We did not talk about me asking you this. What is that? What are people concerned about?
You're always jumping ahead with my materials, so we'll get there. I mean, there's some really good stuff here, but I find it interesting. I don't think did anything really happen this last few months. This is normally one of our most popular podcasts, but I doubt there'll be that many people paying attention to this one. So
no one cares about the markets right now, John. So what'd you find?
All right, so you know what? My process is the same, Dave. My process is the same. I'm going to do this just like we've done the last ones and hopefully, give some people some good tips, guidance, kind of what happened and then how we see things and, what we think might be things to look for, right?
You never grow out of the process, John. You grow into the process.
Ooh, I'm going to use that.
There you go.
All right. So let's just start off like I normally do. I'll give you kind of an overview, economy, markets, what happened in the first quarter. So economic growth. So this is one of those backward-looking, indicators. GDP, from a standpoint of, where was it going? It was actually in pretty good shape, right? We were in, for all intents and purposes, growing. First quarter, Atlanta Fed is now projecting a contraction in the economy. And there's a bunch of reasons for this. It's not just, people aren't spending money, because they are. Companies are making money. We've already seen, earnings reports are starting to come across. It has more to do with kind of a, people getting ahead of the tariffs. It's just one of the ways that GDP is measured it has to do with net imports, net exports, and inventory on hand, and all those things, because there's a lot of imports coming in and not as many exports going out with all these, getting ahead of the tariffs. We're actually expected to see a contraction in our economy this year, for the quarter, I should say. But actually, if you look out, what are the estimates saying for the whole year? We're still getting a lot. Like right now, I'm seeing IMF, International Monetary Fund. It's 1.8% is their estimate for the entire year. You're seeing New York Fed 2.9%, White House, whether you can believe these or not, 2 to 2.5%. So, and there's a bunch more, but basically none of them has really come down and said, oh, we're not really expecting the year to be, a growth year, right? Okay. Maybe more, muted. But yeah, we're still seeing some good forecasts. The consumer, like I said, still seeing spending. Nothing's really come down drastically. We might see a little bit of difference in some of the behaviors that consumers are making, but nothing drastic there. Retail sales started off January negative, but that was more of a weather and kind of, a lot of forward spending for Christmas. I don't know how you work, but that's how ours is. Basically, spending for Christmas starts in my house around October. But then every box you see, that's for Christmas, right? Right? Is that how it goes in your house too?
I don't know. I just don't open anything, John. It's a lot of stuff shows up on the doorstep, and it's not my job.
Yeah. All right. So consumer sentiment. We're actually at some of the lowest readings we've seen in the last 10 years. The consumer does not feel good about what's happening. Some of the habits could change. And again, I think we see this a little bit different on a spectrum between, let's say, lower income households and upper income households. Mm-hmm. I think on the middle, there have definitely been some different attitudes and behaviors. They might be substituting certain things. So maybe we still go on a vacation. We might not go on that vacation that we would have taken, a couple of years ago. Employment. I mean, employment is still very strong. It's still resilient. Job openings, we've gotten a decline in those, but we're still at levels that were above pre-COVID levels. Initial jobless claims are still, and you see these reports I put out every week. Initial jobless claims, you want to see a pattern in these. Are they going up on a regular basis? Well, we've been below a level that you would call historically low, right? So we're not even near levels where I would start to be, okay, these are eye-opening. I need to really pay attention to what's happening. Companies aren't laying off employees yet. So if there is a lot of this fear about what's going to happen with these tariffs and how that's going to affect, we're still not seeing that in employment. All right. One of the things that was kind of hurting us before during COVID was wage growth. So wage growth was going up, and that was causing people, to have more money and spend more money, and we really needed to get a handle on inflation. Well, we're actually seeing wage growth. It's still growing, but it's the rate is some of the lower rates we've had in the last 10 years. So that kind of puts a little bit of we saw some of this. I'll maybe skip ahead with my inflation, but we're seeing some things that are actually positive when it comes to inflation with wages. 4.2% unemployment. So I don't really start to get, the trend has been up, but we're still at very low levels. Don't really start to get concerned about unemployment until we start getting into the mid fours to high fours and start kind of looking at the 5. So not really too worried about that yet.
How far are companies ahead of unemployment? Meaning, if they're going to start laying people off, because you mentioned this twice, how far are companies usually ahead of it? Like if they see it 6 months down the road, 1 year down?
It's definitely lagging. It definitely lags. Okay. What you would generally see as, okay, we're either in a recession or not. These are lagging indicators, employment. But the fact that we haven't seen really anything yet, despite all this headline news, and we've known now for at least a couple months with what we've been hearing with trade policy and all that. If it was really, I think, companies trying to even get ahead of it at all, we'd be seeing, I think, more of that.
Okay.
But it's definitely there's a number of months where you would see some lagging there.
Okay.
Corporate earnings, like we're getting started with earnings season here, a couple of weeks in. So far, we're seeing some growth. It's maybe not as good a growth as we had in the fourth quarter of last year, but it's not as much what did these companies do last quarter. Now everything's kind of changed, and we want to know, all right, are they guiding negatively based on tariffs and trade and all that?
Yep.
Or, is it kind of business as usual? And we're pretty mixed on that. Some companies are actually boosting their guidance. So it's one of those things where we're just trying to sift through a lot of information right now. Federal Reserve still targeting 2 rate cuts for the year. When does that happen? I don't know how much you pay attention. There's a little battle going on between the president and the Fed chair. So, when will we actually see rate cuts? Fed is projecting 2 rate cuts for the year. The market has come down to that a little bit. I think most I've seen is 2 to 3 cuts is what the market is generally expecting. It's way down from where we were before, right? We were expecting a lot more rate cuts quicker. But the economy just stayed too hot. Now we're in this position where inflation has been coming down, but now the Fed has to worry about, okay, is inflation going to pick back up? There's all these expectations now with these tariffs that we could see higher inflation. I've seen some projections that it could add, almost 1% to the current inflation levels, which even the last ones we just got came down markedly. So they're in a position, I think, where nobody wants to be wrong, right? Nobody wants to. It's probably better to be too late than too early this time around. And there's going to be a little bit more fighting, and headlines are dominating everything right now. But again, moving in the right direction. So we're this would be much worse. I can't remember if I told you this or not, or who else, but it'd be much worse if the last inflation number we just got before these tariffs really kind of went into effect. If we had an uptick in inflation there, I think we're even in worse shape right now. But the fact that it went down from 2.8 to 2.4% annualized, we're working from a better place, and I think there's a lot that's actually working in our favor when it comes to inflation.
Are you going to talk about headline news anymore? I don't want to ask you a bunch of questions.
Yeah, we'll get. Yeah, go ahead.
Well, you just mentioned the Fed and the president, and it's like, how are we in a place where if the president just says, I'm not going to fire the guy in charge of the Fed, the market jumps, the Dow jumps up 800 points? It's it's kind of big news, but also seemingly small to the regular person.
Yeah.
Why such volatility with that?
Okay, so if I had to look at it with a big overview, which is a lot of how I do look at it, is we were in a very good place market-wise and economy-wise. policy was the key to this market downturn. It's basically trying to guess at this point what is the actual policy, and companies don't know, and the consumer doesn't know, and investors don't know. So any little clarity, like with Trump definitively saying I'm not, so there was kind of wishy-washy speak before that. Oh, we're looking into, we'll see all that. And him coming out and actually saying, no, I don't intend to fire Powell, is a definitive statement. And Trump can obviously come back and change his mind the next day. But to me, you have to kind of look at President Trump. We've seen this before with him. We've seen a lot of what he says, positioning, posturing, all that type of stuff. It's not always, you can't always take him at face value, right? So there's a little bit of that. But for him to actually come out and say, no, I'm not intending to fire him. Yeah. Right. Whereas before it was wishy-washy. So now the market can say, okay, well, at least we don't have to worry about any, change there or any, tumultuous, transition there.
Yeah. So if I'm we'll call it a retiree with a $1 million IRA, and the president says he's not going to fire someone, and I make $20,000 because of that, or I lose $20,000, should I be worried that anything could be said at any time and I could lose or gain a bunch of money?
All right. So, and I'm not sure how much overlap there is, how many people listening. We put out a piece, pretty recently, and it discussed market volatility. And one of the main parts of that, and, I was trying to get across the point that most of what I'm talking about here, has to do with equities and equity investing and all that. And positioning your portfolio, if I'm a retiree, there really shouldn't be anything that is said or done or market activity. None of that should really matter. Of course, we all have emotions, and we know, people react certain ways when things happen. But when we're talking about equity investing, these are long time frames you should be considering when you're in stocks, right? It's 1 year. It could do anything. It could absolutely do anything. We saw 2 very good years, and it's easy to forget that when you're in the midst of, 20% NASDAQ pullback. But absolutely, anything can happen in a year. But the further time frame you go out, like when we invest people into equities, it's our intention that we're not touching that money, that particular set of money, for a long time, right? So no, they should not be concerned what happens, as long as, that doesn't impact their ability to take income that they need, right? So prolonged periods of time that, and we do stress test these things, but I think there's a point you like to make. It's, all right, what if it just means I can't take $6,000 out this month, I have to take $5,600 out this month? Yep. All right, can I live off $400 less for a period of time? Right. Those are the types of decisions I think we think about from a planning standpoint. But from an equity investing standpoint, absolutely not. This stuff, anything I'm talking about today, I think is more for me to know, and for us to know in positioning client portfolios and how to invest. And we are active managers for the most part. So it's when to take, some position in some particular industry or sector or company versus, not.
Yeah, I and then I'll let you get back to this. But what I keep getting is the fear of folks. This is what people are worried about. Am I going to run out of money? If I'm retired, am I going to run out of money?
Of course.
And there's a difference between running out of money and just saying, hey, let's make an adjustment. Let's take $400 less this month. And if you can make adjustments along the way and course correct, and you're invested properly, that's the other big piece. If you're just talking about equities, well, what about all the other stuff? I should have a safe bucket, right, with X amount of years of expenses in there. And if this continues for more than 3, 4, 5 years, that's a problem. That's a prolonged downturn. Then other things, and then we'd rebalance and do other things. But I think folks are just worried about, am I going to run out of money if the markets are this volatile? And the answer is probably not. And if you do, there's going to be way bigger problems. So
yes, I think, again, if we're doing our jobs, and then, there's, I'm sure a lot of people who listen to this and maybe don't have advisors that don't, do that type of extensive. The worst thing to do is make a move based on what the market is doing today, right? Make a move based on your goals and your strategy and, you know, what your time frame is. And I feel like that's the thing that keeps us. Everybody always assumes I'm getting tons of phone calls right now when this is happening. You know, we want to be in good communication with our clients, but at the same time, I think, you know, sometimes less is more, right? We put out something, but I've seen a lot of companies. How much communication do we get from, you know, different financial companies? I get stuff multiple times a day from the same companies, you know, talking about market volatility pieces and all this. It's, I don't want to make the public or the client think that this is a bigger deal, that we should be more concerned and we should be paying more attention. No, my message is usually the same. Go do some of the things that, you know, make you happy, that give you peace, that, you know, don't watch the financial. And this stuff happens, like, yeah, it sure seems bad when you're in it, but it happens multiple times throughout your life and you survive it. And I don't think this one's going to be any different. It's just, it's always just a question of how much time it takes, right? So if you can do, have you done your estate plan? You know, you talk about this stuff a lot. Have you updated your will? Have you have you made sure all your beneficiaries are the same or should be changed?
What tax moves can we make?
What have you been putting off? Do you need life insurance? Do you need disability insurance? Like, think about some other things other than just stuff you absolutely have no control over. I don't have any control over when the next tweet is coming out that's going to send the market up or down. All right. But I do have a pretty good idea if we've sat down, we've done a financial plan, and we know how much income a client needs, and we've properly positioned those assets between stocks, bonds, alternatives, gold, all that stuff. You know, I have a pretty good feeling that we're going to be, in the long run, okay. Right. Yeah. We just have to guide that client and make sure they don't make the wrong decisions.
I have more people asking, and it's the same thing. They'll call or message us or email and say, I'm sure you're really, really busy right now with questions. I have, that's rare. I have way more people that when we send a video to about market volatility say, and this sounds crazy to the folks that are listening to this, I have more people say, I didn't even know anything bad was happening. Like, how bad is it? Like, now that you've sent me a video, now I'm scared. I wasn't until I heard from you. So as advisors, sometimes it's hard to, like, do we send a bunch of stuff? Do we send very little? We are bombarded, for the listeners out there, all day long. We literally probably 20 to 50 emails or messages a day from different places that are sending us all of this stuff. And, hey, you better get this out to your clients immediately. And we have to filter, what do we send? Because we don't want to send people into a panic. But there are some folks that would appreciate it. Maybe we need to make a list, John. Like, who wants to know when the market's down and who just doesn't? They know it's not in their control.
Let's do it. If you want to be on that list, let us know.
Yeah, there you go.
All right. So we took a little bit of a break there. I talked about the consumer, talked about trade. I mean, I still think we're in a two economies type of situation where, you know, people at the lower ends are hurt right now, and we're seeing some delinquencies and we're seeing some signs of some real struggle at the lower ends. So I don't know, good or bad, whatever you think about what the president is trying to do right now, I think that is his target, to try to help that. And it might be, you know, something that doesn't work out, and it might be something that works. But we're in a period of time where I think, because there's so much news and so much instant access to information, and everybody wants it, and I want it right now, and I want it the way I want it. It's a very short time frame, right? What do we talk about in August, you know, when we were talking about elections, is that there's decisions that get made that don't really have effects for years, right? Yep. So I think trying to judge whether or not what's happening right now is going to be good or bad for markets and economy is a dangerous game. And I choose to just kind of focus on the same things I always focus on. For good or bad, how is the market reacting, and what do I need to do as an investment manager? Do I need to get more defensive? So we'll talk about some of that stuff, but you know, there's certainly challenges right now that we didn't have 3 months ago, right? So maybe I'm not fielding as many phone calls, but I'm certainly much more attuned to a lot of the different indicators and data sets than I had to be 3 months ago, right? End of January. I mean, we'll talk about this with the market stuff. End of January, we were up. Do you remember that? We were up for the year.
John, I've been talking about that a lot. Like, do you remember when you do? How much did the S&P lose in 2022 at the end of the year?
2022, I believe it was down about 20%. I know.
So we had it was somewhere around there. I don't know off the top of my head. But does anybody remember that? I'm telling you, if you went around and asked your clients that are working, people don't typically remember. And that was a year-end statement.
It was a tough year as an advisor, right?
Yeah.
Summer was very tough. I think the low was June.
Most folks don't. It seems like a blip now, but when you're in the middle of losing 20%, that's a big deal.
Yeah, and then what do we have 2 years in a row after? Multiple, 20 plus percent years.
Yeah.
So, talking about the challenges we face right now, it's definitely, I kind of touched upon it, inflation. So it's is it really going to keep coming down, or now, are these tariffs actually something that's going to be put in place? And these are cut and dry. I look at it more as, and I've just try to listen to what the president and his people are saying, is I truly believe, and we'll see if it plays out this way and what the market thinks long term. But just because of what I'm seeing with some of the pops in the market, and that could be regular bear market rally stuff, but the market wants any positive news right now. And it was policy induced, again, to say we have all these strict tariffs. But when I hear and I see tweets about all these companies, and even just this morning, it was announced that 100 companies have contacted the administration about working deals. So I am reading this as they're in search of deals, not to leave permanent tariffs in place, right? So when tariffs get lifted and deals get made, I think that is when the markets actually respond favorably. So I think there's probably an end point to this. I don't think this leads to, some multi-year recession and, global reset and all that.
Yeah.
I definitely look at it as more as tactics based on, some of the days that I've seen and why I see the market responding so well.
Was Tesla one of those companies, John? What happened to Tesla?
Well,
this will be your clip for YouTube right here. What happened to Tesla, John?
What happened to Tesla? Well, so they had their earnings, and I mean, I don't know if you're looking for before that, but there's a lot of voices that are saying Elon Musk does a lot of different things, right? Like he's involved in a lot of different companies, and he's somehow made it work before. But everybody's saying, he needs to get out of this government thing and spend more time with Tesla, and he's basically essentially said that. Right, like he's spending less time, and his goal is to get back into that. But Tesla had terrible earnings, and I think it was up 7.5% after that. So these are actually some of the things you start to watch for not saying this is the market bottom, but those are the types of things you generally will see. When the market's trying to form a bottom is something that should be taken as bad news that the market the market actually responds well to. From a company standpoint, like we had plenty of, even earlier in the quarter, plenty of positive earnings, good earnings. Like NVIDIA was one of them, where it actually did not help the stock. Stock went down. So again, I talk about it's policy driven, it's headline driven. All these tweets, you never know when it's going to change. It's the uncertainty of not knowing. How do I prepare for this if I'm a company that needs to invest? I need to either hire, or do I need to build a plant here in the United States? There's so many decisions that have to be made right now based on information that is fluid, and that's tough to do.
Yeah, so companies are sitting on money, not investing. So if they're sitting on a bunch of money that they would typically and normally invest, and things are still, I mean, obviously it's down, but like once they start putting money back into the markets, is that going to turn things around?
Yeah, I certainly think if you look at it like, this is it, this is the end of the United States and companies on. If you looked at it that way, you would probably set yourself up for some problems, because at some point this stuff is going to resolve itself. At some point the economy is going to turn back around. Again, I don't know when, but yeah, from a standpoint of this could all end conceivably in a matter of weeks, right? We could have deals in place. We could have Trump saying, okay, these 90-day pauses are now permanent. Like, we're not going back. The market is definitely not priced that in right now. They didn't price, and then, that's jumping ahead too, but the market didn't price in the tariffs as bad as they were, right? So that's why the market, tanked so much after Liberation Day.
Yeah.
Right. But then any little positive news, and we've seen some really big spikes on volume. I was looking at it today. We want to see a turnaround, and I've kind of been saying this to our group, is that I anticipate, markets don't go straight up, they don't go straight down. I anticipate a move back, to retest, some of the moving averages. And if you're into technical analysis, go check out that stuff. But it's basically one of the things that I look for. Happens, just about every time. 2022 definitely gave you that chance. But what happened, it's not so much the breaking of a 200-day moving average or a death cross. Like, those don't always mean it's the end and we need to sell everything. It's more about what happens the next time we try to get back above that. I'm watching all the companies, different sectors. I want to see strength in growth companies. I don't want to see just my utilities and my consumer staples and energy companies. I don't want to see them just be the leaders. I want to see, all the big tech companies that led us in the last couple of years. So if those ones are lagging and don't have relative strength on this, and we're in the midst of it. I mean, when I walked into this booth, who knows? I'm not getting any pop-ups or anything, so I don't know if the president has tweeted or put anything out on Truth Social.
No.
But
it's about the same as when you walked in.
Bottom line, we're in the midst of a pretty good two-day thing that could lead into something that goes back up and retests those which would now be potential resistance levels. So as a technical trader or an analyst, and that's essentially how I get an edge in the market with our clients and tactical decisions. That's what I'm looking for. I expect that we'll retest it at some point, and it's, what does it do when we get there? All right. Yeah. So that, to me, I'm cautious, right? Overall, I'm cautious.
Can I ask a question?
Yeah, go ahead.
What is a death cross?
So I've only mentioned this one because they just happened on all the major indexes. It's essentially when a shorter term moving average, the 50-day, crosses below a 200-day moving average. And if your price is below that, that's usually what happens. So it just indicates that all your short-term momentum is down, right? Your long-term trend is up because that's a longer term, 200 days. But it's something that's widely followed. And, if you're talking about computers and algorithmic trading, and there's a lot of stuff that happens around them. And to me, it's no accident. So, I pay a lot of attention to them. But the death cross, it doesn't mean the end of the bull market. We're in a little bit of a correction / bear market within a longer term bull market. And we certainly could turn into a bear market. There's nothing that says we can't. So we have kind of repositioned ourselves to be a little bit more defensive, but there's nothing I've really said, I need to get all into cash, or I need to go all into, consumer staples and be super defensive. But, our strategy certainly has changed a little bit. Right. And I always say that you have to be flexible, right? Mm-hmm. You have to be able to change some of that stuff. These are the times though, you can be, what we always try to say with people, don't be too cute. Yeah, put your money in the market and let it kind of go. But these are definitely the times where an active strategy pays off more than a passive strategy, right? So if you're in a passive strategy, you're all in S&P 500. Well, the biggest sectors of the market are the ones getting hit right now, right? So the biggest components by percentage, the three sectors that led the way, so consumer discretionary, technology, and communication services, those have been hit the hardest, down the most, right? But they're also the biggest percentages of the index. So if you're an S&P 500 index fund, you're down precipitously, right? The best performing sectors right now make up very little of the actual market, right? So energy, I think energy might be 2.8% of the S&P 500. So not really going to move the index, right, even though it's up over 10% or whatever for the first quarter.
John, I'm picturing you coaching your kids' football team or basketball team, and you're running like moving averages while the game is happening. Like you guys go up 20-8 in a basketball game, and then the momentum shifts and it goes the other way. And are you thinking in your head, this is a death cross, I need to call a timeout?
No, it's all advanced analytics. I'm like, okay, from the right wing, he's getting by his defender.
But he's only 2.8% of the market.
Defender coming over, so 75% of the time he needs to dish that off to the open man when the help defense comes over.
How is it?
It does hurt. We had a pretty successful basketball season. We did well.
So that's how you
works
trade your
more
funds.
than it doesn't. So that's the same way I look at this statistics with the markets.
Do you manage your basketball team the same way that you manage funds, or do you manage the funds the same way that you manage your basketball team? That's for your clients.
I'll have to think about that one. We'll put that as an update.
All right, keep going. Sorry.
All right. So I talked a lot about the markets. I mean, we were up in January. It was great. By the end of March, though, S&P was down 5, Dow down 2, NASDAQ down 3 or 10. And it's kind of even silly to think in terms of the quarter because a lot's happened even since then.
Yeah.
I looked at it today. We'd have to do, I think from early morning this morning, we'd have to do about 12% to get back to the highs of the year. Okay. So it's not inconceivable because we have days where the market moves 4%, 6%. But it's generally one of those things where, a lot of people look at it as like, oh, is this the time to get out? Is this that's the question we get, do we need to make a change? And it's more about for someone like me, it's looking at what are the companies, what's my target list? Because if we do bounce out of this, if we do respond well around those technical levels, I was saying, these are the companies that I want to buy, right? Yeah. So I don't buy yet. I definitely am not a bottom catcher. It's more about what are the companies that are doing well relatively to the market. And then once I kind of get my all clear signals, that's like, all right, I want to own these ones.
Why doesn't everybody do this?
I don't.
It sounds like
it's a simple strategy. It's not always easy to follow, and there's also I think everybody has emotions with investing, whether it's me or someone for their own funds. If you don't actually follow that process, if you don't, I doubt most individual investors have a process for why they.
Right.
Right.
Yes, most quote do-it-yourself investors, what their process is. There's probably no answer.
Here's I guess an easy way to say it is sometimes we're wrong, but we have to make sure we recognize that early enough to not cost our clients more money, right? So I'm individually, in some of our portfolios buying and selling stocks, right? Individual stocks. So my process would be, there's specific things I look for when I want to buy something or when I need to sell something. And it's really just the process keeps you honest because, hey, listen, I bought this company. I really like this company. But if the market doesn't like the company, who's right? Right? The market's right. I'm wrong. All right. So I need to swallow my pride and sell that company. Look at something else. Right. Yeah. Most individuals don't operate that way. They think of reasons why it's going down, but it's a good company, or like this is where all the investors are going to come. All right, I'll just buy some more, and they keep buying on the way down. And that's what you call dollar cost averaging a loser, which is not a great strategy. I always look at it as there's probably somewhere better to put my money, right, or to put our clients' money. If that company or that sector is wrong, I need to be able to adjust that. Mm-hmm. And conversely, most people don't let their winners go long enough. Right. So we've had companies that, have done very well in sometimes short periods of time. It's like, okay, well, is that one over? It starts coming down a little bit. I need to get out. Mm-hmm. Whereas, nothing, I have specific things I look for. And until those things happen, it's like, okay, you ride this thing as long as it long as it can go. Because
good for you. You know what I was just thinking of recently was, I've heard this so many times. I know you have. If I knew what I knew now, or if I knew then what I know now, I would have bought Amazon or I would have bought Apple back in 1986. Well, what would most people have done if they bought Apple in 1995, John? Do you think they'd still have it?
I mean, there's been lots of stories about people selling, like relatives of the founders and stuff have sold. I think it's Berkshire Hathaway's son sold his shares. Like,
they'd never hold it. That's my point. It's like, you say you would have bought if I put in $1,000 into Apple and now it's worth $1 million, you wouldn't have made it to $1 million.
Yeah. All right. Well, I don't want to get too off the high, but there's different things that I do, from an investment management standpoint that the average investor should not really be concerning themselves with. But for us, it's how do we, improve our actual equity holdings performance, or how do we attempt to do that? Bond market. So bond market has actually been a good place to be. We talked about this for a while now. We just wanted to see bonds. Bonds, I love you, bonds, but you just weren't cutting it. We had a lot of clients that, why do we own bonds? Why do we own bonds? Right? So as an investment manager, as someone that has to diversify, and that's another point, diversification has been fantastic in this period of time. So we've really seen, whether it's international stocks, bonds, they're doing the part that they were chosen for, right? And that's to give us some upside or some stability when the stock market is really not doing that, right? So everyone that's listening right now, this is exactly why we don't always put all your money into the highest growth stocks and just keep them there. Bonds definitely have their place, and they don't seem like it sometimes when they're down, 1-2%, or up 1% when the stock market's up 25. But these are the things that keep our clients invested, right? Is that, if you were all in the NASDAQ and you were down 23%, would you have stuck to your plan versus being I think in the first quarter, even though, like I said, the S&P was down 5%, your average moderate portfolio was maybe up 1%.
Yeah.
So
it's not as sexy, John. So let me ask you this. Okay, I'm gonna stop interrupting because we got to get you through the rest of the two portfolios, and we used to show people this a lot. If you have the same rate, let's do 3 years, right? Let's do investor number one did. Let's even do just 8%. They did 8%, 8%, 8% consistently, 3 years in a row. They start with $100,000. We don't have to do the math live here. Investor number two start with the same $100,000. They go up 50, down 30, back up 10. Their actual rate of return when they look at a statement is 10%. Investor number one does 8% over 3 years, same amount of money. Investor number two does 10% over 3 years, same amount of money to start. Which one has more?
You're steady investor.
Investor number one has more money with a lower rate of return. So a lot of folks go in and pick their own funds based on, 3 years, this average looks great. We actually didn't calculate how much money you have to start and finish with that. So the diversification helps steady that line is what you're saying.
Correct. So, and if you're young and, you're aggressive, you're going to see the big swings, and in general, you're going to be rewarded for that the longer you go. But, the other thing that example doesn't take into account is the amount of investors that just do it by themselves that get 50%, down 50%. Like, there are a lot that just never go back.
Right.
I'm not going to wait. I'm not going to get that 30% because I'm cutting my losses. And, now when I see it go up 30% and then I get back to, where it was, all right, so I just was in a bad time. Right.
Yep.
So, don't do that. All right. We talked bonds, market, talked about the sectors. I kind of am talking about the places that I'm looking for opportunity. If we do get that rejection kind of around those levels, then I am getting more defensive. That's an absolute. But do I necessarily think that's the most likely case? I don't know. I'm of the sort that thinks, interest rates will, over the long run, come down a little bit from here. And the best place historically for that has been your higher growth technology companies. So, those I still think are going to be the ones that probably weather the storms better, and offer us, again, what's my time frame when I'm talking about an individual stock? I'd love to see this thing. Like, we've held, a bunch of them for years. So I'm not looking at, for the most case, I'm not really looking at, what happens over the next 3 months. Yeah. Right. And that piece we showed, right, 2 years and 3 years after the type of volatility spikes we just saw, there wasn't in the last, 16 or 14 instances, when the volatility index got that high, we didn't see any 2 or 3 year period of time where the stock market was down from that point. Right. So, I think the key is always just kind of weather the storm and, don't try to get too cute and think you can time things. And if your risk tolerance was wrong how often have I said, I think every quarter I say the same thing. Go reevaluate risk tolerance. And if you're not in the property, stock investing is risky. Okay. Sometimes we forget that, but it is risky. Well, short periods.
One more thing, John, I got to say this just because when you said the moderate portfolios were probably up 1%, and I know that's a generalization, but a lot of folks, if you watch the news, if I'm 65 years old, John, and I'm watching the news and I don't really look at my portfolio or my investments and I'm just watching the news, any station, it doesn't even matter. And you watch that and then you actually look at your account and you're up 1%, people do not believe that is true. And I almost never lead off client meetings with performance. But certain folks, when they come in, they're just scared. They're coming in because I need to meet with you next week. All right, come on into the office. The very first thing I show is, hey, you're up 1.2%. Or, hey, you're down 1%, whatever it is. And it's usually much, much better. People are coming in thinking they've lost half of their money because we're watching the news so much. And especially if they don't agree with the politics that's happening. Most of the time you can say...
Well, that's the thing now.
Well, and you said, I mean, I can tell by when clients call who they voted for, and that's totally fine. Like, that's up to them. That's their thing. But, like, you can tell before they come in what they're worried about, and it's so much easier to lead off with, hey, you're up 1%. They literally don't believe it. I've had hugs recently just by people saying you didn't lose half of your money because you've been watching the news cycle. So I think that's really interesting when people... They're leading with just fear and headlines, and it's usually not as bad as what you think.
Yeah, I agree with that. I mean, another example of a company that just doesn't care what president. I mean, Netflix, right? Netflix reported earnings and they took off and they're still going, and they looked solid even before, despite all this stuff. And I'm trying to think, okay, what effect did tariffs have on Netflix? Probably none. People are doing less stuff. Are they going to cancel their Netflix? There are opportunities everywhere. And to just, I don't know, this is one of the major reasons I don't try to let like the actual news, dictate how I feel about investing. It's follow the process, all that.
I think Netflix is like alcohol. Like, we're watching Netflix in the bad times. We're going to watch Netflix in the great times.
Well, except for the younger people, I think probably still are on Netflix, but are not drinking alcohol. If you've
That's true.
seen a lot of these studies.
Yeah.
I've got the economic and market scorecards. I talked so much about a lot of this stuff already. Let's just say again, caution. Caution is key right now. So normally I come in and I'm like, I'm bullish on this. I'm very positive on this. It's very prudent to just be cautious. Right. So if you have new money, to apply to the markets, I have less good feelings about where to put that right now.
Yep.
Right. So it's okay to either, if you want to dangle a little bit in, dip your toes in. I think, again, from a time frame standpoint, if you got the time, it's probably not, are you at the bottom? I don't know. Yeah. It could go down further from here. But if your time frame's 10 years, it's okay, right?
John says,
pick some good companies.
Dangle your money into the markets, folks.
Dangle it. Pick some good companies, though. Like, now's not the time to be like, all right, this is the hot meme stock that all the internet's talking about. no, focus on your Dow Jones, your S&P 500. You can go to any web, just do S&P 500 heat map, and it'll show the biggest boxes are the biggest companies on there. I would just focus on those, or even an index, right?
Yep.
But the whole point is be a little bit more cautious right now. All right, so I want to look ahead on inflation, Federal Reserve. So do we get a cut? Does Powell not cut in May just to spite Trump? I don't know. Do we finally get one in June? Maybe. Does the market actually appreciate because of that? It's possible. How does the market react is a big thing to me right now. But by then, I don't know. Are we still dealing with trade stuff? So how long is that going to lead the news cycle? At some point, and I imagine, the people that voted for this administration are going to want to see them get to tax policy, regulation, like make stuff easier for businesses. That's kind of a lot of the reasons I think why the election went the way that it did. So I don't think we're sticking to the trade news cycle forever. And when we get past it, I have a feeling that, we can at least focus on some of the other stuff, and the market may respond well to that. So my bottom line is I don't know how long all this stuff takes, but I do think that there will be an endpoint to it. Mm-hmm. Again, it's more policy driven and headline driven. Consumer jobs, I mean, like I said, it's kind of lagging, but the consumer, I feel like the stuff I'm seeing from a spending standpoint is still fine. The debt levels from a percentage of GDP are not terrible. You might see a headline that says we're at all-time high levels for consumer debt, and that's true. But I've talked about this in previous podcasts. That's definitely more at the lower end of the spectrum, and middle income above upper class still hasn't really changed their spending habits. In fact, more have spent in trying to get ahead of the tariffs. If you had any home renovation, or you needed lumber, you needed a car, any of that stuff, people were still spending it until the jobs really weaken to the point where there's not enough people to buy the products. We're not going to really have a revenue problem. Right. Let's see. Oh, just saw, was it yesterday? UBS upgraded U.S. equities. So just kind of from this thought of think like a professional. If professional company, UBS, major asset manager, thinks, it looks more like an attractive time to buy stocks. The average person wants to buy stocks when they've been running up like crazy. And, I just think about the phone calls you get when a company it went up 30% or went up. Sometimes you see them, they're at $2 and, now the client's calling, hey, it's at $50. Should we buy it? No. I definitely shared these stories before. We get those.
The answer is maybe, John.
No.
Maybe. Depending.
Sleep on it.
That's right.
It's a impulse buy. All right. Just like you walk by something at Lowe's, think about it for a little bit first. And then, all this stuff that's kind of making the market move right now, that isn't a first quarter thing. It's more of a, how I'm watching what the market responds to positive news. And it's, the talk of the de-escalation of the tariffs and the softening, and maybe we're making some progress with China. The CEO of Goldman Sachs, David Solomon, yesterday was on the news, and he was basically saying, we just need to see a couple trade deals go through, and he thinks, that kind of changes the whole paradigm. So really, the market, in my estimation, is not pricing in positive news when it comes to trade. And if that happens, everybody that's sold out of the market is going to get punished when they realize, oh, I made a mistake. That's one scenario. The other scenario is, stuff doesn't go as rosy, and then Trump doubles down and all that. And then now we are kind of in, making new lows after this. I'm more of the assumption that I think stuff gets resolved. We were under a pretty good economic scenario before that. And once that stuff resolves and we move on to, some of the other stuff, tax and
Well, we have state laws too. Like, I want to ask you about the Tax Cuts and Job Act, but we're running on 50 minutes.
Oh,
right
no,
so
no.
Let me
Cut
ask
this
you
one
now.
down.
No, there's no edits, guys. If Trump comes out today and says no more tariffs, how much will the S&P and Dow Jones go up today, John?
I don't know. It would probably, like the last time, even when he softened and did the 90-day pause. I think what did we hit, 9% that day?
Is that crazy?
Up.
Yeah.
So the fact is, we've come down so far so fast, and yeah, you can have V recoveries, but you know, I'm here to say I don't. Just anybody else. I don't know exactly how everything happens. I know how I'll react if I see certain things, right?
Yep.
From an asset management standpoint. Does that mean every, buddy in their 401k should, go making a bunch of changes? No, absolutely not. I learn new things about the market every week. Every week. I do so much reading and research, and I follow different people, and I just can't imagine trying to do this all right without knowing half the stuff that I've learned, throughout my career, and trying to make those. So for most people, it's simple. Just don't respond. Don't make changes. Don't give into the emotions that come with this type of stuff when you're seeing every single day, sometimes intraday swings of 5% in the stock market. It's just something I think that's playing out right now. And, if you want to look at it from president came in with what he thought was a lot of political capital, and, he's trying to take care of something that he thinks is an issue. Is it going to last forever? Probably not. But what if it works? I don't know.
Yeah.
Like if it actually works, I don't want to be sitting on the sidelines with my client's money because, I'm scared.
Yeah. Yeah. So, all right, John, we're going to wrap this up, and I'm going to say, just like the markets, John Harms does not like uncertainty. And he does not want to be scared anymore. But John, thanks for doing this again, man. We're at 52 minutes. I love it. We'll see you again in 3 months to see how accurate this was. We're going to hold you to it. I'm going to replay this right before, and I'm going to quiz you like crazy on the next one. But
I'm making a list.
There you go,
man. A list, all the doubters.
Thanks, John. Folks, make it a great day.